Hey guys, what's up? It's Elder's Forex Trading Alliance. Listen, if you ever been stopped out by some random wick in the market, you're not alone. Millions of traders get stopped out by the market daily. And the thing is, you get stopped out in the worst possible spot. And after the stop loss gets hit, the market goes exactly where you wanted. Without you. And the annoying part is you were basically right. Your stop loss was just in the wrong place. So let me show you my method to fix your stop loss getting hit. It's not perfect, but it's probably better what you currently have going on in your trading charts. So let's get started. So here's the thing, most beginner traders get stopped out because they put their stop loss in the most random and obvious places. Let me show you exactly what I mean. A newbie trader might look at the chart and see this little support and resistance cluster. They then decide they're gonna trade the breakout of the cluster. So they see a bullish engulfing candlestick on the charts, which is a breakout, and pretty much that's a textbook signal to buy. However, unfortunately for them, if they took this trade, the market would have went against them. Yes, the market did move up a little bit, but the obvious direction was of course bearish. The only reason it went towards the downside is because the push has already happened. Price doesn't just move in a vertical line, although I wish it did. It moves in a push exhaustion cycle, which we can see happening just over here. A strong push, which is your number one, and an exhaustion, which is your number two. Push, exhaustion. So this trade would have been a loser unless you had a massive stop loss, which is very unlikely. So instead of doing all that, we want to actually use proven logic to measure our stop loss. And how do we do it? By measuring the market volatility. This is the ATR indicator. ATR will tell you how far price normally moves. So the logic is, if the average candlestick moves 20 pips, placing a 10 pip stop loss makes 0 sense. ATR will solve that problem automatically for you. So where do we find it? It's a popular indicator. Head over to the indicators tab, type in ATR, which translates to average true range indicator. Once you have it on your charts, double click on it and make sure in the input section the length is 14. I messed around with ATR settings before in scalping or swing trading. There was not really much of a big difference, so keep the default, don't worry about it. I'll give you another indicator to help you guys out, but first let's understand the context. You always want to trade the high and low of the swing. And as we can see, goes towards the upside, goes towards the downside, goes towards the upside, and can we get downside? There we go. You want to trade the low and the high because that's where the most orders are. If you don't know how to spot the highs and lows, use this indicator, higher high, lower low, live. It will show you all the swings necessary. You can mark them out. Since I've been trading for over 10 years, I don't need this, but I think anyone that's new, it's going to be a great tool. So now what can we see? We know that this is the swing low, right? So this is where we want to target, right? Currently, the market is dropping down. This is our swing low over here. We can actually mark this zone out, something like this, you know, supply and demand. There we go. This is a great demand zone. Now, the idea behind the ATR indicator is very simple. We want to utilize the actual movement in the market, right? So let me just turn this indicator off and actually look at the numbers the ATR is currently giving us. So if we have a look over here on this exact candlestick, 0.417 means 41 pips or 41.7 pips. That's all it means. That's the average price movement on the 4-hour chart. Now, what I like to do myself is go to the daily time frame and just measure the ATR volatility, right? So it's around 105. It can be, 100, that was the low. So 100, 105. So let's just round it up for easy numbers. 100 pips is the daily average true range, which means that if the market goes down 100 pips, it's very likely it might go up 100 pips. You see where I'm getting at? So what you actually do is wait for the market to start its price action. So over here was the last day's candlestick, right? So this was Friday, then this is Sunday. So we measure the last day's candlestick. So over here, boom, we measure it and let's see how many pips is going down. 100 pips. It went down 100 pips and it's still daytime, right? This is day trading hours, this red candlestick over here. So this is perfect. The market has already went 100 pips, which is the daily average true range. And all you want to do is then long your trading position once it hits that 100 pip threshold. And your stop loss now is just a 4-hour ATR. So 4-hour ATR is 420. The market has already been exhausted on the higher time frame. So this is our stop loss, and our target profit is of course somewhere at the very top of the swing, right? For the perfect stop loss placement and the perfect entry in this case, we cannot just have it like that, where the market is not covering the previous area swing, right? Stop loss over here is not covering the swing low. We cannot enter the trade. You want to cover that with your stop loss. Once that is covered, you are allowed to trade. Of course, you can get a better entry. Let's say if the market goes down over here, you can enter somewhere over here, maybe even make your stop loss slightly tighter. This does happen, but I'm saying you are allowed to trade once it hits the market threshold, right? So this is the perfect trade setup, perfect stop loss. Let's see what happens. And the market shoots towards the upside very nicely, and this would have been a perfect stop loss and a perfect entry. By utilizing this technique, you are not trading somewhere in the middle, somewhere random where the market can push and kind of drop you out. You're trading off swing highs and lows. You're covering the swings. Daily market is exhausted. 4 hours stop loss is perfect, right? I've used this method many years now in my Forex signals as well, and it works really, really well. Of course, I need to mention higher time frame trend really does matter. So weekly, monthly has to trend in the same direction as the trade. So if it's consolidating on the 4 hour, maybe on the dailies, it has to be making nice higher highs, higher lows. Weekly, the same thing. This will add to your winning percentage. So yeah, that's my stop loss strategy. Hopefully you guys learned something. So if you're new, make sure to apply it, make sure to practice it. Of course, you can add a little confluence to it. There's a ton of things you can do. It's not just this model that works. You need to add everything like a big ass soup. Once you put all the right ingredients, your trading will become next level. So yeah, you may want to join my group, link below. Anyway, watch this video next. Take care, Lions. Have a wonderful day. Stay safe and goodbye.